Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Donald Trump's team is set to consider pairing former Fed official Kevin Warsh in the Treasury Secretary role alongside hedge fund manager Scott Bessent at the National Economic Council. Bloomberg has learned the US Justice Department is looking to force Google to sell off its Chrome browser in what would be an historic crackdown on one of the world's biggest tech companies. Plus, Poland's head of state accuses Germany's Olaf Scholz of trying to cut Donald Trump out of talks over the future of Ukraine.
In the meantime, a quick check on these markets. You're seeing green on the screen when it comes to the futures picture. Outperformance in the UK. We kind of saw the opposite in yesterday's session. The FTSE 100 higher by 0.4% futures trading. Euro Stoxx 50 higher by only 0.2%. Weakness in the currency market, though. Euro dollar at a 105 handle. Cable at 126. The countdown to the opening trade starts right now.
Tuesday morning, good morning. There is a distinct lack of clarity out there on so many fronts. It is hard to make big decisions. The White House, the incoming White House team, certainly suffering from that at the moment when it comes to the Treasury pick. But markets broadly, I think, are really struggling with what the agenda is right now and which direction, therefore, ultimately risk assets are going to be heading in. Is this a healthy market? Is it easy to stay invested? What do you do with those investments? I think everybody's struggling with these questions right now. But the Trump team certainly appears to be on the horns of a dilemma as well. We are waiting to find out still who the next Treasury Secretary is going to be.
And a new name has entered the fray, Kevin Warsh. I think this is a fascinating one because we've been talking about this pick for, I want to say, a couple weeks now, and his name hasn't come up just yet. But his CV, to me, is what's most interesting. He's had experience on the board of governors before. He's worked under George W. Bush. He's married, I'm told, to billionaire heiress Jane Lauder as well, whose family has previously been a big Republican donor. He's kind of got all the credentials, not to mention some time on Wall Street as well, Morgan Stanley.
He has been pretty skeptical about protectionism and tariffs, as you would expect from somebody who worked at the Fed, which just adds to the sense of uncertainty about, you know, even if we know who gets this role, when we know who gets this role, we still won't know what influence they will exert on the president in terms of that tariffs narrative.
Or what influence the president will exert on them. I think probably more likely. It appears that he's looking for somebody reasonably evangelical about the Trump story. Yes, I think pretty much everybody, it seems, on the list can get on board with tax cuts. Pretty much everybody can get on board with the idea that we need to think about how the deficit is financed and what we do with that next in the United States. But this issue of tariffs seems to be the area that separates everybody. And he hasn't found the person yet, it seems, to deliver.
Some donors from other donors to the Republican Party. I mean, even Ken Griffin of Citadel, of course, big supporter of Trump and the Republican Party, but saying that he's got real reservations about the tariff agenda.
Well, the line that President-elect Donald Trump has to toe here is he's trying to avoid a repeat of Steven Mnuchin, who, again, was touted in Wall Street, was a previous banker as well, but then also, to your point, had concerns about the tariff story. Does he just need a loyalist here, or does he need someone who can actually do the job?
Is Kevin Warsh a yes man? We don't know the answer to that question, yes or no. But there's also another factor, I think, which needs to be borne in mind here, which the market, it feels like, hasn't yet really latched onto, and this is the idea of what happens with immigration. What happens with deportations, because that has had such a profound impact on the US labour market and inflation and the ability to hire people and not see significant wage inflation. And I do wonder whether we're focusing an awful lot on tariffs right now, but I wonder whether or not that combined with a significant deportation strategy, which Trump yesterday was on Truth Social talking about the idea that he does believe that the military should be involved in this process. The combination of those two could have a dramatic economic effect.
And there have been plenty of economists who, over the last couple of years, have been sitting with us around this desk talking about the impact that immigration has had on the labour market. Should we go to some of the corporate news flow that we're following this morning, and this around Google? So could we see Alphabet being forced to sell the Chrome browser? This, if it happened, and this is something that the DOJ is asking the judge to make a possibility. If it were to happen, it would be seen in, real historical sense compared to Microsoft, the unsuccessful attempts to break up Microsoft some years ago. But I should point out, Bloomberg Intelligence saying that they don't see this as likely. There are appeals that can happen here. If it did happen, though, really interesting to see how this changes the artificial intelligence race, because even if this is about illegally monopolising the search market over years gone by, the search market is integral to what Google is trying to do on AI.
It is, and it looks like they're going to maybe take action on that in terms of allowing opt-outs in that area And I think that would be significant as well. Would the Trump administration continue this? Because the signal seems to be thus far that actually the Trump administration is not that friendly towards big tech. So would this be a continuation if this was to be pursued? Would this be something that will be continued into the new administration?
Maybe it depends which big tech. He's had firm views on certain big tech, hasn't he?
He's not a fan of Mark Zuckerberg, for example. Elon Musk isn't either, we should point out. Not to mention, I know there's been concerns around Apple, for example, under tariff policy back in the first administration as well. The DOJ one is interesting because 61% of the internet browsers is Chrome. That's how much it makes up. It's really important for the business model, as Anna was pointing out, because this is how Google gets its advertising, is able to target people. It's kind of the core of their whole business. So by taking away Chrome, do you basically undermine the entire company? I think that would be the source of the appeals.
Yeah, absolutely. So that's why it's being seen as it would be so huge. It would be such a massive step. To your point, though, I mean, this started under the first Trump administration.
Yep.
This legal action. Yeah. And it's rumbled on and it's rumbled on. And, you know, if it goes through appeal, maybe, well, we'll certainly be into the second Trump administration, won't we?
Can we point out very quickly that Google or Alphabet is a good chunk of the stock market as well? I'm sure that's not going to reflect well for Donald Trump if that's the gauge he's looking at.
Would a broken up Google be worth more than Google? Don't know. That's an interesting question. It's the sum of the parts valuation. You need to look at some of these big tech companies, maybe as conglomerates. Would breaking them up actually release value, or would it destroy value? I don't think we know the answer to that question yet. But to your point, maybe there are synergies within the business which would work, and therefore, actually, this could be value destructive. We don't know. 1,000 days today. 1,000 days since the invasion of Ukraine. 1,000 days that this war has impacted the world and had a dramatic effect not only on Russia, Ukraine, but also on Europe as well. And it does seem as if there is a growing sense that 2025 is the year in which this conflict comes to a close. The question is, how does that happen? And that's the bit that I think a lot of people are grappling with at the moment. Olaf Scholz making calls to Vladimir Putin, the United States giving Zelensky long-range missiles, Europe struggling with whether or not it should deliver more missiles, certainly Germany struggling with that, the US being more maybe equivocal in terms of its decision around longer-range missiles. We don't know here. There's so much uncertainty around this story at the moment, but the conclusion seems to be that 2025 is the year that we come to a close.
One of the few things people seem to agree on is that Europe is going to have to spend more on defence. And that seems to be echoed in some research from Bloomberg Intelligence overnight, saying 15 European NATO states, they're going to have to increase their spending, more than double it, in fact. And this could take 10 years because of some of the supply constraints that those who operate in this sector are under.
It's fascinating how quickly the narrative has changed post Donald Trump's election. The narrative around Russia, that perhaps what was initially a negative for Ukraine could be a positive for Ukraine, and the idea that this conflict could come to an end. Yes, with potential kind of concessions that maybe we wanted, but you can see it on the chart in front of you that Ukrainian bonds have been rallying since that moment, which was not the narrative ahead of the election.
No. It's so much uncertainty. We just don't know yet how this is going to play out. We don't know what the ultimate cost is going to be for Ukraine. The amount of funding that's going to be required not only to rearm Europe, but to rebuild Ukraine is going to be absolutely epic. Let's talk about what we've got coming up on the show. We've got plenty to discuss. Do you hate this market? How much do you hate this market? I think it's one of the key questions that we're going to be talking about. But we want to come back to the idea of what is happening with the space race. The US seems to have a significant lead. I think there's going to be a rocket launch a little bit later on today. I think Donald Trump's actually going to attend that SpaceX launch. Helene, Huby, the CEO and co-founder of the exploration company, a European startup building an alternative SpaceX Dragon capsule, an alternative to the SpaceX Dragon capsule, is going to be joining us. Do we need to see consolidation within the European space story as well? Airbus has been talking about that. Ian Hartnett, co-founder and chief investment strategist at Absolute Strategy Research, is going to be joining us. And Natan Tiefenbrun, President of North America and European Equities at CBOE Global Markets, is going to be joining us. We are going to be talking about an integrated tape. Is that what Europe needs, Kriti, to sort its capital markets out?
Maybe. The selection process doesn't start until June 2025, so we'll see what that actually looks like. Not to mention getting plenty of pushback from the exchanges as well. But there's plenty to look forward to in the next 24 hours, and some of that includes what's going on, of course, in the Treasury. We have our eye on the new Treasury pick, as we were talking about. By 10 a.m., we also have a committee hearing. Andrew Bailey is going to be speaking. Sorry, I should specify, this is the UK Treasury, not the US Treasury. But Treasury, nonetheless, on both sides of the Atlantic, very much in focus. At 12 p.m., we get Walmart earnings. A check on the consumer in the United States, perhaps a little bit on disposable income. The comp sales are expected to fall, so that's going to be a key one that I've got my eye on as well. And the Canadian CPI at 1:30 p.m. UK time, right alongside those U.S. housing starts. So a little bit of a dry data day, but who knows?
Well, we have the Walmart earnings, don't we? And I wonder, yes, there'll be a lot of focus on the consumer, so that's going to be really important. You know, the lead up to holiday spending and any gauge on that and the strength of the consumer. I wonder if there's any narrative, any opportunity for narrative around tariffs. That would be really interesting, a retailer that size weighing in with thoughts ahead of the imposition of any tariffs and what that would mean.
Retail sales in the States have been really strong recently.
Yeah.
The upper-end consumer is still spending. Does that mean that actually this whole idea that people were trading down into the Walmart space actually doesn't play out this time in the way that we would have anticipated maybe a few months ago?
One of my favorite charts is if you look at recession indicators and Walmart stock price, it is a literal inverse relation because of this dynamic that you're pointing out. We'll see how this all shakes out, because the other piece of it, yes, it's consumer spending, is also that Walmart has a whole kind of gas station kind of business as well. So there's an oil market story there in addition to the tariff story that Anna was mentioning.
Let's talk about what else you need to know this Tuesday morning. Novo Nordisk is launching its top-selling Wegovy obesity drug in China at a fraction of the US price. A key step in unlocking a big, fast-growing market for its blockbuster franchise. Novo's main rival in the space, Eli Lilly, has also gained Chinese approval for its weight loss drug. Novo plans to limit the initial China launch for Wegovy to avoid supply disruption. The ECB's President Christine Lagarde is urging Europe to pool its resources in areas like defence and climate to boost productivity growth. Her call for greater integration echoes warnings from other policymakers who say that Donald Trump's return could accelerate a new era of protectionism that would be harmful for Europe's economy. And a Hong Kong court has sentenced former democracy advocate Benny Tai to 10 years in prison, the longest sentence ever issued using a China-imposed security law. The sentence is likely to further deter dissent in Hong Kong and attract significant condemnation from Western governments, which have already criticised the case as, quote, politically motivated. It's interesting. We've got a Hong Kong finance forum taking place and a Hong Kong court case making headlines at the same time.
The juxtaposition of these two things is not missed on anybody, really. I mean, given especially that this the financial markets summit, the Global Financial Leaders Investment Summit, to give it its proper name, it's in its third year, and it was specifically brought in post-pandemic, but also post-riots, post-civil unrest, to try and address the financial industry's concerns around all that, or rebuild the reputation of Hong Kong. And the fact that this is happening on the same day that we see 45 people, pro-democracy activists, being sentenced is an awkward juxtaposition, perhaps.
It's a really interesting one as well, and I think you pointed out ahead of the start of the show that there are some major names on Wall Street as well who have started to kind of caution against that story in China and the transparency they're going to get there, which is being reflected, by the way, in this exodus of fund flow out of the region.
Yes, so more around the transparency of capital markets and where money is allowed to flow in and out, but Goldman Sachs and Morgan Stanley both actively talking about that at that event in Hong Kong. We'll have more on that as we go through the programme. Also coming up on the programme, President-elect Donald Trump is said to be planning then to attend the launch of Elon Musk's Starship rocket in Texas later on today, as Guy was just referencing. Well, we'll bring you that story. We'll get into the latest on the European attempts to rival SpaceX, at least in the development of a capsule. And we'll talk about the valuation of SpaceX, of course, as well. Plus, Bill Winters says China needs a final jolt of fiscal stimulus to restore consumer and business confidence. We'll bring you some of our interview with the Standard Chartered CEO. That's coming up later in the programme. And up next, we're joined by Sophie Huyn, who is Senior Cross-Asset Strategist at BNP Paribas Asset Management. If you have questions and you want to get involved in any of these conversations, we really do like to hear from you. IB plus BBTV Go, that is the function to use on the Bloomberg terminal. This is Bloomberg.
We've seen this movie before in 2018, 2019. I didn't see much inflation coming from that. We had a corporate tax cut late 2017. I didn't see much inflation from that. So I don't think that that's the right narrative for this.
Jim Bullard, former St. Louis Fed president, speaking to Bloomberg TV about what's happening in the United States right now. Let's talk about what happened in the United States yesterday. The long end of the bond market beginning to attract a little bit of a bid, which is interesting. Are we getting to levels where actually the yield is good enough, the value is good enough that people want to get in on the long end, which has been a tough trade recently? Barry Totel has more.
Guy, for a second session in a row now, we have seen some pretty sizable appetite for treasuries. On Friday, it was focused on the 10-year sector. Yesterday, it was focused in the long end. We had 30-year yields rise to new highs they'd not seen since May. But after that, there was a sizable buying in the long end. It reversed that completely. It goes to show that maybe we are just hitting those levels for investors that are attracting more and more people into fixed income. I want to point out another asset that has seen some sizable dip buying, and that is gold. Gold slid nearly 8% after Trump won the U.S. presidential election, but we've seen 2 days now where the gold has bounced from those lows, up over 2% now in just 2 days. A lot of that has to do also with the weakening move of the dollar. The dollar's recent strength did dent the appetite for gold. We've seen all of that kind of reverse, but very interesting to see gold outperforming the last 2 days. I want to show you one more chart on just how gold has performed year to date against stocks, because they are battling neck and neck for the top asset for this year, for 2024's top asset crown. We've seen the S&P 500 return 25% and gold up there too at 26% year to date gains for the yellow metal. Guy, it is very unusual to see these top two assets outperform together. The last time gold had outperformed this much is back during the financial crisis, where there was a real risk-off bid into the yellow metal. It's very different dynamics driving it this time this year. Maybe some central bank buying, maybe perhaps other central banks wanting to diversify away from treasuries, causing this bid into the yellow metal. But it's very interesting to see both the equity market and the gold market outperform this year neck and neck.
Just yet another confusing signal that these markets are kicking out to sort of completely flummox investors, I think, at the moment as to what they're supposed to be doing next. Valerie, thank you very much indeed. We're joined now by Sophie Heighten, Senior Cross-Asset Strategist at BNP Paribas Asset Management, joining us around the table, sitting with us. Good morning.
Good morning.
Are you confused? This market, I can't get my head around what is going on. There's so many confusing signals. Gold and stocks being neck and neck seems just one of them.
I think it's hard. So when you look at what happened post-election, we got all the positive outcomes and positive impact of like this MAGA administration playing out. Stocks went up, small caps outperformed, the dollar went up. It was like the perfect playbook as 2016. But I think it's wrong. I think there's too much complacency. I think the market is not pricing enough the potential negative impact that we could have.
But where does the catalyst come from? This is the problem, is that I can write a long list of things that could go wrong, should go wrong, maybe will go wrong.
Yeah.
I just don't know when I put those into kind of the playbook, because at the moment there just doesn't seem to be a catalyst, an obvious catalyst, to get the market down more than 4 or 5%, which would be a kind of minor correction.
So if you look at all asset classes, what's been the perfect pricing of a Trump outcome has been on the FX side. If you look at the rates market as well as the equity market, it's been like not all the way in. So I think what could break the market is actually this reacceleration, supply-demand dynamics heating, and like the bond vigilantes starting to worry about the sustainability of fiscal trajectories. If the 10-years start hitting 5.5 or 6%, I don't think risky assets are going to take it well.
No.
So that's interesting. So you think it's about the fiscal questions that the market will start asking rather than the tariff questions? Because look, it's easy to focus in on the tariff policy because it seems quite out of step with mainstream thinking and Wall Street thinking, I suppose. And yet you think it's going to be the fiscal side of things that's the risk factor for markets right now.
I think it's a bit of combination of everything. I think it's going to be the sequencing of like what the top stories for a MAGA administration is basically tariff, the immigration, and the fiscal policies. The first two, like all of them are inflationary. The first two are potential growth negative. So I think if we start to worry about like fiscal, but also the rate supply dynamics, you need to think about as well what are tariffs as well as immigration going to impact the growth outlook. We are at the late stage of the cycle. It's different from 2016 where we were more early stage. So I think the economy overall is much more negative to negative shocks.
And that's interesting. So that sort of takes on Jim Bullard's comment that we heard earlier, that he said, I didn't see a lot of inflation back then in the first Trump administration, so I'm not going to worry too much about it. I think that he was sort of suggesting it's an unfounded fear. But you think because we're in a different stage of the cycle, this time around, things like immigration policy and tariff policy, they will be inflationary.
The post-COVID world is making the world much more sensitive to any price increase. So I think we need to be aware of this. And let's say risky assets have been very supported by the ongoing central bank's cuts. What happens if they start pausing? I think the market will need to put back and increase the priority of a hard landing, and at a time where global risk premium are currently very tight.
Sophie, I remember a time where an 8 handle on the VIX was considered simply too high and too volatile. And it feels like in a Trump 2.0 and even in a Biden 1.0, volatility has been the trade that has consistently paid off, except for right now, post-election, when the VIX is actually coming down. What happens to that trade?
I think we're going to have vol higher. So if you look at the range of outcomes on the Fed, on rates, on the economy, as well as the equity market, I think the range of outcomes has widened so much that I think vol will remain elevated for the whole year next year.
So how do you hedge it? How do you play it?
I think one way is to basically have like long vol in your portfolio. I think having as well portfolio hedges as a long gold position or long the Japanese yen, basically cheap hedges to protect your portfolio makes sense.
So can we just go bit by bit on the list you just gave us?
Yeah.
The long vol trade has not worked post-election. It's actually done the exact opposite. The yen is subject to the DOJ and really subject to the Fed as well. There's a lot of fund flows coming out of Japan for that very exposure. People are saying gold might be one, but even that has, some would argue that the valuation is simply too high. Outside of the traditional havens, could tech find a way as a hedge as opposed to a core part of a portfolio?
So bit by bit. So if you think about vol, like vol was high into election, it collapsed post-election because markets were worried about a potential contested election. Didn't happen. Vol collapsed. It supported risky assets. I think yen, there's going to be a pain threshold for the Bank of Japan to start intervening. So I think like from an asymmetry, it's clearly there. On gold, central banks buying, positioning, and ETF buying in the background will continue support. So at the moment, if we look at our models, there's like a 25% premium on gold due to central banks buying. I think it's still going to remain in the background throughout the next 5-10 years. And then if we look at, so what was your last question?
I was just going to say, is tech very quickly?
Yeah,
is tech
so
working?
I think tech, it's going to be a hedge for portfolios, long duration exposure. But I think where you want to find value is actually on China tech, not on U.S. tech.
A really fascinating conversation there. Sophie Nguyen, we'll leave the conversation there. Going bit by bit through all the assets, we thank you so much. The Senior Cross-Asset Strategist over at BNP Paribas Asset Management. Coming up, we take a little bit of a pivot, but maybe not as far. Sophie there was talking a little bit about the Trump trade, how you navigate in this era of volatility. Some would argue that space may be the bet to be making. We'll be joined by Helene, Huby, CEO of the exploration company, about the reusable capsule it's developing to rival SpaceX's Dragon. The idea here simply being that, well, we may actually see a European contender, a European player that can compete with Elon Musk. Is this basically a repeat of the 80s where so much of the money is spent in this arena? It's certainly something that President-elect Trump has been talking about on the campaign trail, and certainly something that's showing up in the pricing of not only defense stocks, but certainly around Elon Musk's stocks as well, not to mention federal funding that's going towards some of these private projects as well. In the meantime, European futures are pointed higher. You are seeing the FTSE 100 outperform higher by about 0.4%. Brent crude trading at a 73 handle. We're going to keep you apprised of these markets. Stick with us. This is Bloomberg.
Welcome back to the programme. This is the opening trade. 30 minutes until we get that opening trade for Europe this Tuesday morning. Let's have a look at the futures picture then, shall we, and see how we are positioned. Expecting to go a little bit higher at the start of trade. US futures also pointing a touch higher. Asian markets, equities trading a little higher. It seems that a little bit of respite from the higher yield story acting as something of a tailwind for markets, and so could push stocks a little higher, but not by much, as you see there on that chart. On the bond markets then, what do we see? We see some buying. We see those yields coming down a little bit in the European space, just as we see in the United States as well. A little bit of movement on yields, a little lower. Let's talk about space. SpaceX is due to carry out a 6th test flight of its Starship rocket following last month's successful launch. That saw the Super Heavy booster successfully return to the launch site, where it was caught by the chopstick arms of the launch tower. Those are apparently the appropriate words to use in this situation. Last week, Bloomberg learned that SpaceX is in early discussions to sell insider shares that could value the company at around $255 billion. Joining us around the table is our Bloomberg Aerospace reporter, Kate Duffy, and we're going to widen the conversation in just a moment. Kate, very nice to have you with us. So what's expected to happen during this Starship launch tonight, then? Give us some context about what's on the agenda for later on.
So we're expecting to see a lot of duplicates that happened in the previous mission. So that previous mission was about a month ago. And as you said, we're looking to see that Super Heavy booster being caught by the mechanical arms.
We get to see that again?
Tower. We hopefully, yeah, if all goes well.
Chopsticks, OK, because this captivated people's imagination. I was talking to CEOs that week who were just kept mentioning this as being something that was really inspiring
Donald
for them.
Trump talked about it.
Yeah.
He's going to be there to witness this one, apparently.
Yeah, absolutely, yeah. And hopefully we'll see the upper stage of the booster land or do the splashdown in the Indian Ocean. So that's something else that we're going to see. But they are taking a step forward from the previous test as well. They're going to be looking to enhance capabilities of the ship and the booster itself, such as like an in-space engine burn. So, yeah, it's just like one step closer to them being able to fully reuse this rocket again and lower costs.
How big an impact does this have in terms of SpaceX's valuation? This feels like it's a significant step forward. Is that going to be reflected in terms of what this company is worth? And do we need to fold in the kind of Elon Musk factor, Donald Trump factor into this story as well for the valuation?
Yeah, it really affirms SpaceX's status as the most valuable private US company at the moment, and really shows the sort of sheer size and scope of the company as well. Since its founding in 2002, it's grown so much. President Gwynne Shotwell, she said recently that Starlink was the one thing to make SpaceX so valuable at the moment, and the company actually plans to make money off this year. So you've got the Starlink, that's the sort of satellite internet service that they have. You've got the Starship launches happening. You've got regular Falcon 9 launches pretty much every week. And also these sort of list of NASA contracts that they have with the sort of ISS shipment of cargo and humans up into space as well. So, yeah, I mean, the valuation could maybe only grow further from here.
Kate, I'm tempted to ask you what a spacesuit feels like. I really want to know. But instead, I'll ask you a little bit about Europe's take on this, specifically because so much money historically has been invested in the United States in space exploration and now in the private sector as well. How does Europe compare?
Yeah, it's a big difference. There's a very different landscape between the two. The US, they're launching rockets almost every week. And now with Elon Musk in Donald Trump's administration and very high up, space is only going to become more of a priority for the US. And this really widens the gap between the US and the European space sector itself. I mean, Europe has pockets of expertise. They've got really interesting startups with new technologies, developing really interesting ideas. But there have been a lot of setbacks. For example, this year we've had the delay of the second launch of the Ariane 6 rocket, and we've also had a delay to Rocket Factory Augsburg's flight test in the Shetland Islands. So both of those are now expected to happen next year instead of this year. Failures aren't uncommon in the space industry. That's something that SpaceX has also had to deal with from a very young age. But it's years ahead of Europe now, and it's just dealing with that, and hopefully Europe can can sort of catch up.
OK, well, let's take that thought a little further. Kate, stay with us. We're joined now from Paris by Helene Huby, who is the CEO and co-founder of the exploration company, which has its own ambitions in space and is making progress on them. Helene, very nice to speak to you, and thank you for joining us. Just this week, you've successfully raised some more money, I think, for the development of the Nix capsule, which is Europe's response to the SpaceX Dragon capsule. Tell us what you want to do with Nix and how quickly.
Yes, thank you very much for having me. Nix is the capsule you can see in the background here. And indeed, what we want to build, what we are building, is the first European space capsule. So we're going to bring cargo to station around the Earth, around the Moon. The first destination will be the International Space Station. And then hopefully we're going to fly humans.
Hopefully fly humans. And fly humans to, what, the International Space Station? I mean, how quickly is that a real prospect?
So humans, flying humans, it's quite a long endeavor. Typically, if you look at SpaceX, if you look at China, if you look at India, it has taken around about 10 years to build a crew vehicle. And we are starting with cargo because it's easier. It's less time, basically, to certify the vehicle. It's a great way to learn. So to learn fast, to learn at, so to say, lower cost. But we're already planning to fly humans in the sense that we design our vehicle to respect as much as possible the crew requirements that NASA has established. So hopefully in perhaps 11, 12 years, we'll be able to fly crew. And I think that would be very important for Europe, very inspirational also. It is typically something that Europe cannot do as just one country. It's such a big endeavor that it kind of epitomizes what we can do together when we cooperate.
So Helene, good morning. You're going to do the capsule. Who's going to do the rocket?
So specificity of our company that's actually unique in the world, we are rocket agnostic. Rocket is quite important cost in the equation. So for us, it was very important that we could play the competition. Also, our clients, they are either the American private space stations, but they are also like space agencies. For example, European Space Agency is going to buy our first mission. We've already signed 800 million contract in dollar. And so if we want to serve countries like India, Japan, we are actually compatible with Japanese launcher. We are compatible with India launcher. We're, of course, compatible with American launchers. And we're compatible, of course, with Ariane in Europe, so European rockets.
Kate, let's just come back to you. We have a capsule there that potentially is rocket agnostic and therefore can sit on top of a number of different rockets. Helene mentions what is happening with Ariane. But as you said earlier, we have this slightly fragmented picture across Europe. In the United States, it feels more consolidated. How does Europe pull in the same direction and develop a space industry that is European and kind of has all the various component parts required? Is that something that's possible? Airbus has created an aircraft manufacturing business from lots of different component parts from Europe. Can we do the same thing in space?
We are sort of seeing this already, that companies could potentially be coming together to create a bigger sort of company for space and develop all the capabilities needed for us to get to that point. I mean, as Helene was saying, you know, having an alternative to SpaceX's Crew Dragon capsule, that gives Europe a much better competitive edge. So if we could come together, companies bringing their space departments together and putting their heads together and creating those developments, then that would really put us forward. And we have, you know, seen that Airbus could be doing that with some companies, in particular, potentially Thales. There are those reports out there. So that's something that could happen. It's very much on the table at the moment.
Helene, it's Kriti in London. I want to bring you back into the conversation here. When we talk about these strides that European space companies like yourself are making, it feels like if we follow the American roadmap on space exploration, so much of it has been federally funded. The idea of having French, German, arguably other countries support these ventures, how important is that? Or is Europe maybe having the advantage where they can skip ahead to getting more of that private investment? How are you thinking about it?
So first, I'm very proud to say that the Series B that we've raised, so 160 million USD, is the biggest Series B ever raised by a startup in Europe. And we have kept the vast majority of our shareholders Europeans. 98% of the shareholders of the exploration company are Europeans. So that's a clear like proof that if we come with bold ambitions in Europe, we can find here in Europe the money to actually finance these bold ambitions. Now, space is hard, space is risky, space takes a lot of time to build very complex systems like capsules or rockets. And for this endeavor, I believe it's very important to be supported by governments. It's not something you want to do alone with private investors. And SpaceX has also been heavily supported by NASA. So we are learning from that example. And we've established a company in Germany, in France, in Italy. We've also opened in Houston, Texas, in the US. But like 90% of the people are located in Europe, in these various countries. And we are actually proud to be supported by the European Space Agency. That is to say, by these countries and also other European countries that we are gathering alongside our ambition. As an example, when we started the company, there was no capsule program in Europe, right? Nothing. We had 50K in the bank account, that's it. Now we are 3 years after the foundation of the company, only 3 years. We've raised 215 million euro. We have contributed with the European Space Agency actually to launch a capsule competition that we won. We ranked #1 in this competition. We signed 800 million in contract, and we grew the team from 4 people to a bit more than 200 people now. So we actually proved that it's feasible to have fast-growing companies in Europe. And you were mentioning the example of Airbus. That's exactly what we want to build. We believe if we want to build global leaders with European roots, it's important to bring together these European countries with very bold ambitions. And yes, we are late. It's very clear if I compare the exploration company with SpaceX, we are very late. But history has demonstrated that even like Airbus, when we start late, after a technical catch-up, if we come up with bold ideas, disruptive projects, there is a chance actually to catch up. So we want to take this chance and let's see what is happening.
Well, Helene, you mentioned a crucial piece, which is that fiscal support, that government support is so important to those ambitions that you just laid out. But I'm curious how much of that extends to the Trump administration at a time when it feels like space is now becoming a bigger and bigger part of the defense architecture of not just the United States, but several other players around the world. How are you thinking about maybe future-proofing, Trump-proofing what you've created?
So I think space is becoming, will become also between the link and the excellent relation between Elon Musk and Trump, something which is going to be like core of the American strategy. It's also absolutely core for defense for any country, as you mentioned. Space has become like a critical infrastructure on Earth and for defense. So there is now the need actually to protect space asset in space. Regarding Europe, I hope that actually this huge push towards space that I believe we're going to see in the US, and also the fact that the Trump administration is going to be more like America first, hopefully will be a wake-up call for Europe to have more ambitious projects. And we have money, so I'm not sure it's only a question of money. I think it's a question of shared ambition. If we have shared ambitions, very bold ambitions, then the money will follow when we find the money, because it's not true that there is no money in Europe. But unfortunately, very often we have like nationalistic ambitions, so scattered ambitions, and because of that, we cannot pull our strength together. And this is what is slowing down. Yeah. So I hope this push that in space that we're going for sure to see in the US will have a catalyst effect in Europe so that we can pull our strengths together and build on something very bold, which is what we need.
Helene, Huby, a fascinating conversation. We thank you so much for your time and joining us this morning, CEO and co-founder of the Exploration Company, and of course, our very own Kate Duffy, our aerospace reporter right here in London. Coming up on the program, it's the world's largest food company lowering its profitability target. We're going to get more on Nestle in today's Stock to Watch next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. Just 13 minutes until we start trading here in Europe, and the futures picture looks flat to positive this morning. One of the key questions hanging over markets right now is who is President-elect Donald Trump going to pick for his cabinet for some of the key economic posts. Let's get to Kriti with some analysis.
Well, one of the new names has entered the fray, Anna. Kevin Warsh. We've been talking about this for a week, and his name hasn't come up yet until just now. A potential dynamic duo in Washington, at least that's what the reports suggest, between Kevin Warsh, a former Fed governor, we'll get back to his history in a moment, and Scott Bessent, of course, the key frontrunner that was initially thought to take over the Treasury Secretary role. He's now facing pushback on the idea that he may not be tough enough when it comes to that tariff policy, really bringing about this idea of what is loyalty, what does that look like in Trump administration, given the pushback Donald Trump has felt in his previous administration from this role. This duo together could be what forms the new National Economic Council and the Treasury as well. But who is Kevin Warsh? That is the crux of the issue. Because, again, it's a name that we don't often talk about. He was the Morgan Stanley executive director before entering politics, a longtime Republican, a special assistant on economic policy to George W. Bush, and then some time at the Federal Reserve as well. Between 2006 and 2011, he was on the Board of Governors. And in 2017, a contender for Fed Chair Jay Powell's seat. He's also married to Jane Lauder, the billionaire heiress whose father, Ronald Lauder, is a major Republican donor. Did not donate to the current Trump campaign, but has in previous iterations. It's not, of course, a sure thing yet. There are still plenty of other contenders to keep an eye on. Howard Lutnick is one example. Scott Bessent, as we talked about before. And then a slew of others, including Mark Rowan, a Wall Street favorite, the Apollo CEO.
Yes, over in Hong Kong at that finance meeting we were talking about earlier, Mark Rowan. Kriti, thank you for setting up that part of the conversation. Joining us now for a look at the markets then in 3 minutes, our Markets Live executive editor, Mark Cudmore, with us, of course, from Singapore. Mark, so that's hanging over markets, lack of clarity around Trump picks, but also we're starting to see a little bit of softness maybe creeping into some of the Trump trades and the dollar being first amongst them. What do you read into that softness over the last week or so?
Yeah, I think it's really interesting. I think most of the initial Trump trades are running out of steam already, with crypto being the big exception. But we saw stocks already have a bad week last week and kind of give back half their initial election gains. So the stocks trade ended first. The dollar turned yesterday. Now, what everyone's kind of wondering at the moment, is this just a temporary consolidation before the next dollar leg of strength into year end? And that is certainly the majority consensus out there. I'm a little bit more worried that we might see the dollar a little bit softer into year end. Seasonally, this tends to be a bit of a soft patch for the dollar. And I think a lot of people are realizing that, A, Trump doesn't get inaugurated for a while, then he's got to appoint people, then the policies are going to come in, and then we still don't know what policy mix will actually be delivered. Kriti's just outlined the uncertainty around the Treasury Secretary, which is very key to that kind of pick, many of these key policy picks for the dollar. So kind of people are realizing that maybe even if these policies are all very dollar supportive, they might be many months away from being implemented. Meanwhile, we've already priced in a bit of the rate support. So I kind of, with very low conviction, I can see dollar softening a little bit from here into year end, maybe before next year getting dollar strength again.
Mark, that's the phrase that I keep hearing time and time again. Low conviction, high uncertainty. Nobody really seems to have a handle on what is happening right now. How abnormal does the market environment feel at the moment?
Yeah, it's a great question. I was just talking actually over the last few days about how this is a particularly acute headline trading market. And what's interesting is people aren't really even trading concrete headlines, concrete news. They're trading the latest rumor or speculation around the appointments, which is kind of bizarre because the impact will be so far away. So I think this is has been quite an unusual market, but I don't expect it to continue for much longer. I think we're moving beyond that. We're going to go back to focusing on fundamentals for a while. Sure, we're probably going to be in a news headline and trading environment for the next couple of years, but I don't think it'll be quite as extreme as the last few days where we kind of whiplash on every single random speculation that we get out there on Twitter.
Mark, do Treasury yields go up or down when we know who the pick is?
I guess it really depends on who the pick is. But I think that, it's a good question. Is there an asymmetric setup there? I think probably the asymmetric setup is for yields to go higher, assuming it is a candidate which looks likely it'll be approved and everyone will be popular behind, because it'll just be say, hey, we're getting a step closer to those Trump policies. And I think one of the consensus agreement is there that whatever Trump policies get eventually delivered, most of them will result in higher long-end yields, either through higher inflation, higher growth, or through increasing the fiscal deficit. There are many different components to that idea of higher yields coming from that.
Certainly something we're keeping a close eye on. 440 on the 10-year yield this morning. Bloomberg Markets Live executive editor Mark Cudmore, we thank you so much. Let's go from the macro to the micro. Joe Easton standing by with our stocks to watch. Joe.
Morning, Kriti. So Nestle giving some guidance in its capital markets today, predicting margins of around 17% for the year ahead. That is slightly below some of the previous targets that they gave, and also sales growth of around 4%. That is a little bit below the numbers they gave around 6 months ago. However, the initial take from analysts is that a bigger downgrade to guidance has been avoided. That had been feared coming into this, and the silver lining as well is that the company says their water business, which includes brands like San Pellegrino, that will become a standalone company, so potentially spinning out some of the valuation on that one. We can see the stock underperforming as consumers still continue to trade down due to the cost of living crisis, however. Then over in the tobacco stocks, we've got Imperial Brands once again reporting a slump in tobacco volumes, really the heavy lifting coming from the next generation products, so vapes, and that has helped that stock to hit a 5-year high recently, and we can see that analysts remain very bullish on this one despite the downgrade to the tobacco forecast. We can see 9 buys, not a single sell on at that company. Finally, in Spanish banks, Caixabank upgrading some of its dividend targets today, continuing to benefit from the rising rates. That is the second best Spanish bank. This stock only behind Banco Sabadell, the stock that had a takeover bid. So that one could potentially be strong today. Couple of sells, 3 analysts turning bearish on that one at the moment, but potentially that dividend boost is going to be enough to lift the Spanish lender today.
Joe, thank you very much. Joe Easton with some of those stocks that could be in focus. We'll keep an eye on the mining sector, as we often do, but today iron ore prices once again going higher, and this a day after we saw that sector as the best performing in Europe just yesterday.
So Costin, Goldman Sachs over in the States raising its target for the S&P. Sharon Bell over here in Europe cutting her target at Goldman Sachs for the stock 600. 12-month target for the pan-European benchmark lowered to 530 from 540, cutting their expectations over at Goldman Sachs, basically noting tepid economics as the backdrop for that call, which seems kind of reasonably consensus at the moment.
So buy the U.S., sell Europe. Where else are we seeing that? In Eurodollar? In the bond market?
Interesting,
a
then
little bit
maybe
everywhere.
Rate expectations not enough to underpin a sort of pro-Europe stocks trade, which is interesting. Lots to talk about then on the programme. We'll be back with the opening trade shortly. Futures are pointing a little bit higher this morning, not with a huge, shall we channel that conversation of earlier, a huge amount of conviction, though. We'll have more. This is Bloomberg.
Tuesday morning, let's talk a little bit about what yesterday delivered in terms of the story, because we're all confused about what's happening in this market. As Mark Cudmore was telling us just a few moments ago, we're trading headlines. We're keeping a firm eye on what is happening in the bond market. Yesterday, it was the longer end of the US Treasury market that was causing the consternation. At these kind of yields, does your equity risk premium really make sense? And I think that was the question the market was asking itself yesterday. So we saw this rally that then kind of faded and ebbed a little bit as we headed into the back end of the session. And to be honest, I think Europe priced most of the rally in, and then the US market really didn't do much. So I'm not sure, Kriti, there's much of a signal out of this chart into your futures.
I don't know, Guy. It kind of feels like the party's continuing, at least here in London. The FTSE 100 is higher by about 0.3%, outperforming what you're seeing in broader Europe. The Eurostoxx 50 futures are up marginally, up only 0.1%. But Anna, the DAX is underperforming, marginally in the red as well. And I'm curious, when we start to see those opening trades, how much of that is the laggard?
Yeah, absolutely. So we'll look for that dispersion, that variation among the different indexes. Let's have a look at some individual stock names, shall we? And just recap some of the stories we were hearing from Joe earlier and add in some others. So Nestle in focus. This business then talking about a standalone water business. What does that portend? They're also reducing their medium-term profit targets. But on the other hand, cost-cutting to try and fund more ad spending and meet their aggressive revenue and profitability targets. So we'll see how the market digests all of that from the Capital Markets Day. Novo Nordisk in focus as it takes Wegovy into China at a price that is lower than the price it sells in the United States, which is an interesting calculation. And Caixabank in focus over in Spain. They've come forward with their return on tangible equity target above 16% by the end of 2027, a new dividend guidance, Guy.
Standalone water business. The headline writers are going to have some fun with that one, I promise you. Let's talk about this market open. Here we go. Tuesday morning. The expectations are that we're going to see maybe mild upside, but actually a fairly mixed market for Europe this morning. Anna's been highlighting what's been happening with maybe some of the mining stocks. The FTSE 100 is up by a massive 0.1% already this morning. This again just speaks to this idea that this market is struggling with a clear sense of direction. We're trading headlines. We don't really have a purpose at the moment. Fundamentals don't really seem to be coming to the fore. We'll talk about whether or not that continues for much longer in just a moment. The stock 600 is up by 0.2%. The IBEX is absolutely flat as a pancake. The CAC 40 is flat as a pancake, up 0.1%. The DAX is down, but only just. There aren't many headlines in what we're seeing here for the European equity market open. Dig below the surface, what do we see, Kriti?
Well, maybe not flat as a pancake, although you have just made me very hungry this morning. When you look at the futures this morning, or excuse me, the index contributions this morning, tech seems to be driving the trade higher. ASML took a little bit of a hit yesterday, so it's no surprise that it is one of their biggest index contributors to the upside. But from a sector perspective, Anna, you are seeing green across the screen. Some outperformance in certain places. The banking sector, the healthcare sector, chemicals are the underperformer. They're flat on the day still, though, so it kind of feels like on the surface a risk-on day.
Yeah, risk-on, and Basic Resources doing their bits, doing their thing in amongst all of that. So Basic Resources, the best performing sector, up by 1.2%. The iron ore price was firmer again through the Asia session. And it's interesting to think about where we are on the China story, where we've got to, and perhaps we'll talk about that in a moment. But we've heard a lot overnight from that forum taking place in Hong Kong about people's hopes and expectations around China on many different fronts, but what they want from authorities and what they want, and Standard Chartered being quite vocal on this final push to boost sentiment in the Chinese market. Really interesting.
Yep. And it's going to be one that I think, if the Chinese market gets going, does that have a ripple effect back into Europe?
Well, I mean, I was just linking the two via Basic Resources, because often it's sort of expectations around that, around the Chinese growth story.
Is it a luxury story? Are there other factors that come into play? It's hard to tell at this stage.
So Glencore, Rio Tinto, as Anna pointed out. Then you also have Nestle, I should point out, one of your biggest volume performers this morning, higher by 1.2%. We're going to dive into the numbers in just a little bit. But basically, they lowered their margin goal. They're boosting their marketing spending, and yet the market is up on that particular stock. Let's get a little bit more of a macro view here. Goldman Sachs chief equity strategist David Kostin, as Guy mentioned earlier, boosted his S&P 500 target to 6,500 for the year end of 2025, citing continued U.S. economic expansion and earnings growth. Now, the new prediction is on par with Morgan Stanley's Mike Wilson, who recommended investors remain nimble in their sector and stock selection. That sounds fairly familiar. Joining us now, Ian Harnett, co-founder and chief investment strategist over at Absolute Strategy Research. All right, 6,500 on the S&P 500 from David Kostin at Goldman. Do you agree?
Yeah, pretty punchy. But, you know, what we're saying to our clients is definitely at the current time, you've got to stay in these markets. It's an environment where we're seeing, you know, a supercharging, if you like, to the U.S. economy with that tax cut potentially coming through. You know, we've talked about, you know, no landing, soft landing. This is actually a go-around. You know, we've got the pilot putting the throttles forward and heading back off the runway. And that's the kind of thing we're seeing in some of our charts. The earnings expectations rising very aggressively, but at the same time, you've got the Fed cutting rates. You just haven't seen that before in the last 30 years. And now we're talking about tax cuts. What's not to like?
Well, we keep talking about earnings growth. We keep talking about a resilient consumer. But the last time we had this narrative, we kind of got hit by this inflation acceleration, right? It was commodity growth, it was supply chain issues, it was wage growth as well. We're talking again about inflation potentially ticking up.
And I think that's the key thing, Kriti, which is actually, you know, we can have this acceleration phase probably lasting perhaps into the middle of next year. But then you start to pay a price. And that price is inflation. And it's interesting, we're seeing in the bond market the way that inflation premia are coming back into these markets. And it's interesting today, Anna, you were talking about those basic resource stocks. You know, people are going to start looking for more of these inflation-sensitive plays as a hedge within their portfolios.
Are you sure the Fed's going to cut rates?
Yeah, Chair
How many more times?
Oh, no, I think we've got multiple cuts still on the agenda. You know, going into the next year, they'll want to make sure that as long as inflation in absolute terms is still, relatively subdued, you know, they will carry on keeping rates going. They're determined to have the best possible growth for the lowest possible inflation. That's the mantra they're using at the moment.
What?
Now, whether it will still hold by the middle of next year, that's a different story, I think.
Does it make sense to own stocks if yields on 10 years at 5%?
We're not quite there yet.
Not far away.
The balance between equities and bonds starts to change, and the type of equities that you might want to own will start to change as well. But for now, yeah, I think you've got to say stick with those equities. Those bonds will probably face a bit of a tougher time over the next few weeks. Indeed, one of our key trades here would be to talk about curve flattening, not curve steepening, because the front end of the curve will start to price in, that more limited response from Chair Powell, and that is where you normally see these flattening trades coming through. So but for the moment, equities still look good. Sorry.
OK, no, so things are looking good. You've set out all the things that look good into the middle of next year, maybe, and maybe then we start to pay the price with a bit of inflation. Bringing things a little closer geographically to home then, Ian, we've heard a lot recently, perhaps unexpectedly, post the election of President-elect Trump, about closeness between the UK and Europe, and this has come out in various arenas and around this desk and in conversations I've had in the radio studio and the like. And I wonder if this is ever going to be tradable. Are we going to see something substantial, or investable, should I say? Is there going to be something substantial enough that becomes an investment theme?
I think the key message that came out of the Mansion House speech yesterday, last week from, Chancellor Reeves and Governor Bailey was this idea about the need to reset UK's position with Europe. But in the same way, the UK cannot re-accelerate and grow and reposition itself within the market unless it's got that dynamic investment coming through. And at the moment, it'll be interesting to see in our asset allocation survey, that we're doing at the current time, whether people's attitudes towards some of these markets has changed. But we haven't actually managed to really re-incentivise corporates, particularly small corporates like the one that I run, to actually reinvest. And that is the heart of the problem for the UK, and I'm not sure that this budget did it. And quite honestly, the bond market is telling you that it didn't do it either. OK,
so the bond market is asking questions. Thinking about the stocks world, though, and the discount that we see attached to European stocks of all flavours, I suppose, versus the United States. We were just discussing what Goldman Sachs is doing on that front. How much of a discount do you think Europe should trade at?
So we've got about a 30% PE discount at the current time. It's close to record lows. We're actually overweight the Eurozone at the current time, a bit more cautious on the UK, but it's actually peripheral Europe that's doing well. And I think that the link into that China story, Guy, that you were talking about is actually that we need Germany at the heart of Europe to be able to get back into that export-driven model, to dump the black zero, and that's where this political debate is taking place at the current time. So it'll be interesting to see how that shapes out. But as Draghi pointed out, the key thing that we need is European Capital Markets Union. And until we get that kind of dynamism in the financial services sector, then we're going to be left behind. And that's true for the UK as well.
I feel like Chrissy should jump in here.
Would you like to?
I'm stunned, Guy. He's got nothing to say now.
I've beaten the subject out of him.
We're going to have a conversation a little bit later on talking about an integrated tape here in Europe. That's the kind of thing that you're basically talking about, the way that Europe needs to figure out a way to harmonise and integrate its capital market.
Yeah, when you look at the growth and the ability that America has had to build out, this second Gilded Age, as some people are calling it, it's actually related to finance. Without finance, you cannot build a new, healthy growth industry. And Europe needs some growth, and that is what, we can't rely on the old models. We've got to get some new models. And, until we've got better financing, we're not going to be able to do that. And that's the message that, that Brussels needs to get.
Oh, I think they've gotten it. They're very aware that they're 50 years late. I think the issue is just more collaboration, isn't it? But I'm curious how much of the playbook needs to change. We actually had this conversation in the last hour with, in regards to a space guest and space financing, and the idea that is it still in government control that does a lot of the financing, or are private markets maybe kind of this new era? Because that's what we're seeing in the U.S., where there's deficit concerns. Private markets are stepping in. Does Europe kind of need to skip ahead past the fiscal and look at private markets as a source of capital?
It doesn't matter whether it's private or public, but actually what it requires is a level playing field in terms of regulations, so that you can, write paper in one country, trade in another country, and it's pretty seamless. in America, that ability to grow the non-bank financial institutions, they now account for almost 75% of the U.S. financial system if you exclude the government. So banks only account for about 25% of U.S. financial assets now. That has been a dramatic change, and if you look at the economies that have done best, it has tended to be those with more non-bank financing rather than very highly regulated bank financing.
Yeah. Ian, I'm curious about your thoughts on the retail sector, because we talk a lot about it in the U.S.
Yeah.
And as I've nerded out about the Consolidated tape, a lot of the pushback is around European retail, which to me feels so much smaller than the American retail base. Is that a real concern? That's maybe to get the financing in these markets, get the liquidity in these markets, you have to engage the smaller players, the much smaller players?
Yeah, it's every part of the equation. At the moment, the UK market, European markets have become such a small component that we're looking at a situation where people just say, well, why should I bother? And that is true at the retail level, it is true at the institutional level. And so until we see a greater focus from institutional regulators to really incentivise international investors to invest in the UK and Europe and retail investors to do that risk investment, not just private equity, because that, if you lose liquidity, and that is dangerous for retail investors. That is dangerous for retail investors. We've got public markets that can do this job and give you similar returns.
Ian, as we leave you, we've been around the world and talked about lots of different markets, but as we leave you, one of the things that's hanging over our conversations this week is the appointment of a new Treasury Secretary. From your perspective, from the perspective of an investor, when we see that name, of who gets that job, what are the sort of thoughts we should be thinking or tests we should be running against their record to assess the impact they're going to have?
Well, I think, the names in the fray at the moment are all fantastically experienced people, whether it's Lutnick, whether it's Besant, whether it's Kevin Walsh. We know that they all have capabilities, but they all have separate strengths. And, I think the key thing that we want to see is somebody that really understands global financial markets, the interaction between the economy and the markets, and the way that their actions can have unintended consequences. I think markets will judge who it is, but I think it's a great choice that the President Trump has here, and I think it'll be an interesting choice as well.
I think it's the intended consequences that maybe some people are worried about. Ian, thank you very much indeed. Ian Hartnett, co-founder and chief investment strategist at Absolute Strategy Research. Thank you very much indeed. OK, let's take a quick look at the Core 6. Then we'll get to Joe and his single stocks. This is what the numbers look like. It's a game of two halves this morning. Novo, LVMH and Ferrari all soft. ASML, Schneider and Nestle all a little higher. Nestle's not up by much this morning. It's really interesting how the market is basically taking the capital markets day that we're seeing in Vevey reasonably evenly. We have seen a downgrading of expectations, but I think that was largely, it appears, already in the price. Let's get more moves. Joe, over to you.
It's a very small move higher in Nestle today. It was up around 1% at the open in Switzerland, now just 0.3%. Almost for that one. Now, the year-to-date context is important. As you were mentioning, a downgrade to guidance already kind of factored in. Down 20% for the year-to-date for Nestle on that year-to-date basis. Really important to factor that in. Of course, the sales guidance does look very slightly lower than expectations. The water business being spun off as well. Potentially a small positive on that stock today. Then we will look at Caixabank over in Spain. This one, surprisingly, actually coming down. Remember, the dividend target's looking pretty bullish. The return on tangible equity also towards the high end of expectations. But again, the year-to-date context is important for this. It's up 50% year-to-date. That is the best year-to-date, or on track for the best year since it IPO'd back in 2007, boosted by the higher rates and also the M&A that we've seen with Sabadell and BBVA potentially boosting that. So coming down, giving up some of those gains this morning. Then we've got Thyssenkrupp over in the steel space. Now, this is a stock that's been slammed recently by the worries around China and also potentially tariffs from the US, given Trump winning the election and the impact for the metals market. So it's coming back up. Again, it's a valuation call with the sales kind of in line with expectations today. That is coming back up around 7% for Thiessen in Germany this morning. Then in the healthcare space and technology, we've got Novo. This is in the hearing aids, listed over in Switzerland as well. Had a big win recently with Costco in the US stocking their hearing aids. And we saw the stock rallying recently, rallying into this report. So it is coming down a little bit, despite the sales pretty much in line with analyst expectations for Novo in hearing aids today. Then in terms of the ratings, a big one from Bank of America. They downgrade Siemens, the massive industrial giant over in Germany. It's all about the automated factories, according to Buffett, not selling enough for them, and therefore the guidance coming down, as we saw from the company just last week on Siemens. So that one slipping, underperforming. Buffett is now a neutral. We're down 1.6% for that one. And then finally, here in the UK, Sainsbury's. This is the preferred supermarket over at RBC. They say a sell-off related to the rise in national insurance that we saw in the budget is overdone. That stock down pretty sharply over the past few months. RBC has outperformed, and that stock is rising at 1% on the FTSE 100 this morning.
OK, Joe, thank you very much. Yeah, so earlier gains fading a little bit. The FTSE is still higher, up by 0.3%, but elsewhere we see some weakness. Autos, consumer products, all a little bit softer this morning. Coming up on the programme, we'll return to the tech theme. The US Department of Justice is set to push Google to sell its Chrome browser in an attempt to break its search monopoly. We will get more on that story next. This is Bloomberg.
Welcome back. Watching the opening trade. We're 20 minutes into the session, 19 minutes into the session. European equities reasonably mixed, as you can see this morning. Not a clear sense of direction being demonstrated on the boards in front of you. Do we get a little bit of a sense of direction later? Do we need to wait for a Treasury Secretary to be picked by the incoming Trump administration before we get that sense of direction? Anyway, we'll wait and see. Let's talk about some of the other stories that are certainly moving markets this morning. Bloomberg has learnt the US Justice Department is set to ask a judge to force Google to sell its Chrome browser in what could be a historic crackdown on the big tech company. For more, let's bring in Bloomberg intelligence analyst Tamlin Baser. Good morning.
Good morning.
So we're kind of waiting to get the clarity that we need on this story, but it looks like this could be certainly something that the DOJ is going to proceed with. What happens once that process starts to unfold?
Right, exactly. And that's where we are now. So the judge found on liability. It did find earlier this year that Google had maintained an illegal monopoly in search. So right now we're preparing for the remedial trial, which is going to be upcoming in April. It's going to be about a 1 to 2 week trial. So what we're hearing right now is reports that the DOJ is going to say, as the primary focus of this remedy, it wants Chrome to be divested from Google. So Google's going to respond to this, and this is all going to play out at this April trial.
OK, so then we're not at the end of this story yet by any stretch. Talk to us about the interplay between politics and the administration and what these courts find, because on the one hand, I am sure there's supposed to be plenty of distance between, but we are about to go into another Trump presidency, and he's got very outspoken views, just as many presidents have had, about the role of tech and big tech. What should we know about a second Trump term in this case?
Yeah, absolutely. And this case actually began in Trump's first term, which kind of shows you the long tail that these antitrust cases, they go on for years and years and years. So this was something that was pushed for by the first Trump administration. And if you look at sort of Trump and sort of Biden, it's been sort of bipartisan antagonism towards a lot of the big tech, and certainly in monopoly. So under a new Trump administration, we're sort of waiting to see who some of the key people in key positions are going to be. Certainly you might have a sort of more relaxed environment on M&A, but it's really unclear if sort of the aggression over big tech on some of these monopoly practices is going to change. And also in this specific case, I think the judge is not really going to worry too much about the administration. He's going to look at the potential remedies that are being recommended by the DOJ and then sort of Google's response.
So that's interesting. So it's not, so when we're talking about the interplay between politics and these court rulings, it's not necessarily that we're thinking about political pressure. It's just that when bodies make decisions about which cases to bring, that might be politically influenced.
That's absolutely the right way to look at it. The judges themselves are most likely not going to bring a political bent to it, but it's the terms that potentially even the remedies that the Department of Justice is pushing, those are some things that might have a political slant to them.
When it comes to some of these remedies, though, does it change the actual business model of Google, of Alphabet, just given that Chrome is, I think I read somewhere, 61% of the domains around the world? It's how Google gets its advertising. Is this kind of what underpins or unpins completely or unravels the company?
So yeah, Chrome is incredibly important to Google. It is what it uses to really get a lot of the data on your browsing history that it then uses to really tailor ads. So it's a very crucial piece of this advertising part for Google. So the question is, are there some other remedies? And the judge, I think, is going to be very interested in what are some other potential remedies that are less drastic that might also help unwind this illegal monopoly that he has already found that Google does have.
Yeah, certainly something we're going to be keeping a very, very close eye on as we monitor the situation. Bloomberg's Tamlin Basin joining us to kind of break down what that DOJ potential crackdown on Google may actually look like in that Chrome spinoff. There's another company that we've got our eye on, and that's the world's biggest food maker, Nestle, seeking to revive its sluggish sales growth by boosting its marketing spending. Shares are down about 0.7%. Let's bring in Bloomberg's Dasha Afanasieva, who's actually at the Nestle headquarters in Switzerland right now for their Capital Markets Day. Dasha, walk us through what we've learned.
Hiya. Yesterday, the new CEO, Laurent Freixer, said that sales will grow 4% plus in the medium term. That's assuming that Nestle's categories grow 3 to 4%. Which is what Nestle estimates. On top of that, they are, as you said, reducing their profitability goal from what Freixer's predecessor estimated. So now it's going to be around 17%. So the idea is that for years, Nestle's brands did not receive enough investment. So now customers have turned away, particularly during the cost of living squeeze. And now it's all about investing that little bit more in brands to coax them back. On top of that, we learned that they're going to separate the global water business, which is brands like Perrier and Aquapana, and then look into strategic opportunities. Well, the way they phrased it was partnerships. So it does kind of raise the question of, will they end up selling this business, which is actually a lot less profitable than Nestle as a whole. The other piece of the puzzle is, whilst you've got increased investment in advertising and marketing, they're actually trying to find the cost savings elsewhere, particularly in the medium term. And by 2027, they're going to have 2.5 billion Swiss francs in cost savings on top of previous cost savings that were previously announced.
Yeah. Dasha, this doesn't feel radical. This doesn't feel out of whack with what the market was largely looking for. And you're certainly seeing that in the share price reaction this morning. Is there an expectation that the new management team may have to go further, or is this about as much as is required to get this business back on track?
Yeah, I think on the one hand, maybe we shouldn't be that surprised that it's not radical, because although you had the dramatic ouster, Freixer has been with the company for almost 40 years and has been in top management. In terms of whether we'd expect more, there are analysts who said we expected more disposals. I certainly spoke to a lot of investors who didn't think water would be on the chopping block, but thought other parts of the business that were underperforming. But instead, the CEO has said that on the whole, told investors today in a very rainy and grey Vevey, that he would be trying to overhaul those businesses within Nestle rather than selling them. So I think that he's got these goals, and it's going to be reassuring that he thinks it's still a mid-single digit, roughly, business overall in the medium term. And then if he can't reach that, I guess he could sell other things. But I should note that some people also think that mid-single digit number's ambitious, or that 4% plus number is ambitious.
Dasha Afanasieva there, joining us from a rainy Vevey to, I think, what's a snowy London. We thank you so much for breaking that down. Coming up on the program, we're going to talk a little bit more about the Consolidated tape. Natan Tiefenbrun from CBOE Global Markets is joining the program in an exclusive interview to talk about what those next steps may actually look like. Stick with us. This is Bloomberg. This is the opening trade. We're about 30 minutes into today's session, and sentiment has soured everywhere but the UK. You're seeing the FTSE 100 higher by about 0.3%, but you're seeing the other parts of the European continent actually trade lower. So a little bit of perhaps that catch up that we saw in the US trade as well. Let's take a little bit of a big picture look, though, because one of the big conversations we're happening is, yes, the Trump trade, it's yes, the geopolitics, but it's also how Europe does a little bit of catching up in terms of making these markets a little bit more liquid. And that's what I want to zero in on. In a bid to make those financial markets more competitive, the EU is looking to create a single market for capital, pooling prices, trading volumes, and other information from over, get this, 500 execution venues across 27 countries into a single data stream. Now, it does sound ambitious, but that's what a consolidated tape is. It's technology that existed 50 years ago in the United States, and it could make investments easier to cross borders here in Europe. And although it does have some broad support, not everyone is convinced. Well, the process is alive and well. One contender to do that is for the pan-European equities business is CBOE Europe. It's partnered with Akis Exchange in a new company called Simplicity. And the man behind it all is Natan Tiefenbrun, CBOE Global Markets President of North America and European Equities, joining us around the table this morning.
Good morning.
Good morning. I've kind of set it up a little bit. It's a complicated issue. It's something that is trickier in Europe with 27 countries. Why can you do it? Why can you pull it off?
Well, first of all, I think those who opposed the introduction of a tape made the point that it was too complex. I think they're over-egging that a little bit. We don't think it's particularly difficult. We already consolidate data today from all of the pan-European equity venues and from all off-exchange trading. We do that day-to-day as part of our existing business, as do Aquis, our partner in Simplicity. So we're really confident that we can do this because fundamentally we do much of it already.
But there seems to be a question of pre-trade, of post-trade, and because of this resistance, I'm curious about how quickly the uptake could actually come to fruition. What kind of timeline are we looking at here?
That's a great question. So the Pan-European Supervisory Authority, ESMA, will start the selection process for the equities tape in June of next year or July, and then they'll have about 6 months to select an operator. And once they've selected an operator, that operator will have a reasonable amount of time to launch the service. How quickly consumers will adopt the service is, of course, harder to predict. And that will come down to two crucial factors, whether it's priced competitively, it's attractive, and also whether the licensing framework offers significant efficiencies compared to purchasing data independently from each of the 27 underlying exchanges.
I'm glad you're starting to get into the nuts and bolts because, to your point of exchanges, you need a lot of broad support to make this happen for that adoption. And lucky for all of us, we had a conversation last week with one of these exchange operators, Stefan Bujna, of course, the CEO of Euronext, joined the program. Take a listen to what he had to say about adopting the consolidated tape and the concerns around it.
We believe that a full consolidated tape would create a situation where insiders would have access to good prices and retail investors will get the leftovers in terms of spreads. So we don't like it, and that's why we believe that an order book, a transparent order book, is the best place for retail to contribute to the market and to benefit from the market.
So Stefan Bujna, there, the CEO of Euronext, talking to us a little bit about his concerns there. Basically, that it would edge out the smaller investors, edge out the retail players, and that's why he's vouching for a post-trade consolidated tape, but not a pre-trade consolidated tape. What do you say to that? That concern that it edges out the smaller players?
I don't think that's a genuine concern. First of all, legislators have already decided it is going to be a pre- and post-trade tape, and all exchanges, all large exchanges, are obligated to contribute their data. So at this point, the ship is sailing, the train is pulling out of the station. But it is interesting, there are two contenders for the equity tape so far. One of them is a consortium of incumbent exchanges who have largely, as Stefan just did, opposed the introduction of the tape. And fundamentally, the tape will introduce competition for the availability of market data.
Yeah.
So I think exchanges today prefer that investors have to purchase data directly from them bilaterally, and the tape will offer them an alternative to purchase the data on a pan-European aggregate basis under a single contract and at a single price.
Does data get cheaper?
I think it will get cheaper, and certainly in two ways. There's the price, the explicit price,
yep,
but also the cost of administering the distribution of that data within your organization and using it for multiple purposes. And that possibly is seen as a threat by some of the incumbent exchanges.
Shall I just look at the US and what it does and see the technology, the application as being the benchmark here of what we're going to ultimately see here in Europe? Is it a kind of one-for-one?
I think our requirements are somewhat simpler than in the US. So the US, as well as having a consolidated tape, the SIP, also has something called the Reg NMS, the National Market System, which kind of links all the exchanges together in terms of how they trade with one another. We don't have that same regulatory framework, so the tape is not going to be used as heavily for some low-latency trading applications. So it's an easier problem to solve in Europe than it is in the US.
That's interesting to hear. Natan, is this going to be something that materially adds to attracting capital for Europe? Because a lot of people pile this in with Capital Markets Union and say, you know, there are other bits that are missing, but this is also missing, and we need this for that reason.
Yeah, I think the answer is it's necessary but not sufficient. So, of course, European markets are fragmented, they're difficult and complex to access, and you know, the tape is a part of the furniture that you need to present you know, a European shop front that is attractive to global investors. There's also the European equivalent of Edgar, a database of all company news and filings, etc. But there's also more that needs to be done to unlock the sources of capital, so the Capital Markets Union, or renamed the Saving and Investment Union, and also to encourage issuers, companies, to raise equity capital rather than debt finance.
Yes, so necessary but not sufficient. Will it be material? Will it have a material impact on those CMU, or by another name, intentions?
We believe so. I think what we see around Europe is that, for example, an average retail broker, they will market domestic trading to their customers and they'll market US trading to their customers. But what they don't do is offer pan-European trading access, and that's due to the complexity and the expense of sourcing European market data from all these different venues. So we think it's about changing that landscape and that behavior to be more pan-European in outlook.
So you say pan-European. We talked about 500 exchanges that you have to basically get on board. We talked about the concerns about having a pre-trade consolidated tape, and that's where the pushback kind of lies. And I understand that it's been in the regulatory framework already, but for the adoption for the exchanges, how can you make this a little bit more palatable? What kind of concessions maybe can you make?
So ESMA is essentially stipulating the format that exchanges will provide their data in. And as I said, all large exchanges are obligated to provide their data. So the adoption problem is not on the data submission, it's on the consumption side. And that's where it comes back to the attractiveness of the pricing and the licensing framework. For any given equity trading in Europe, there are only 4 or 5 exchanges that it trades on. So that 500 number was an exaggeration thrown around when incumbents were trying to put policymakers off the scent on this important initiative.
The exchanges often use legislation. It is law, therefore I have to charge X for this piece of data. And that's something you hear when you talk to certain exchanges about how they are going to pursue their pricing models. How much flexibility is there within the pricing model? You talk about pricing coming down for data. Many of the companies that are watching this program at the moment spend huge amounts of money on their pricing. Is this the cleanest way to get lower pricing for the users of the data, do you think, around Europe?
I think there are many different types of data, but if we're talking explicitly about real-time market data, you know, I work in financial markets. I'm a big believer in competition as being the appropriate mechanism to drive pricing improvement to consumers. So the aim of the tape is to introduce an alternate source for the same or similar data, and thereby create competitive tension around pricing. And certainly we'd advocate in favour of that versus any kind of intervention, government intervention on pricing. So we hope it will work to that effect.
Natan, great to see you. Thank you very much indeed for coming and seeing us. Natan Tiefenbrun, the President of North American and European Equities at CBOE Global Markets. Thank you very much indeed. Nice to see you. Coming up, we're going to talk about what is happening in Germany. The Chancellor there, Olaf Scholz, leaving his domestic woes behind him as he takes the world stage at the G20. Germany's never far behind him, though, and there are plenty of issues that are in focus relating to what is happening at home. We'll talk about all of those next. This is Bloomberg.
Welcome back to the programme. This is the opening trade. We're seeing something of a risk-off move in markets, and it's not just stocks. We're seeing stocks weaker, yes, but bonds on the rise, and we see yields therefore dropping a little, both in the States and here in Europe. The yen then on the rise. Not entirely clear what's been driving this, but just around the same time, we started to hear some more lines coming through from Russia about their reaction function to some of the news flow we've heard from the United States around the use of long-range weapons into Russia. So we'll keep all of that under review, Kriti, as we watch these fairly substantial moves in the yen.
Yeah, and you mentioned the yen. I should mention the Swiss franc is appreciating as well, as is gold, seeing a little bit of a bump. And, of course, you mentioned the boon move. You're seeing it in the Treasury move. So your classic haven bid is alive and well in this market.
It's interesting, isn't it? The market is really struggling for a sense of direction. The market is really struggling for a narrative to latch onto and figure out what is happening here. It feels like, Mark was talking about this earlier, we're really trading on headlines. Like, really trading on headlines at the moment, because there isn't this kind of obvious North Star for the market to kind of get its hands on.
And he was talking about some of the move we've seen in the last few days in the dollar, and now that seems to be gaining momentum and pace. So we'll continue to monitor that. Let's talk about some of the things that have been going on in Hong Kong over the last 24 hours. Important conversation. Standard Chartered CEO Bill Winters says Chinese markets are beginning to improve, but it'll probably take more fiscal stimulus to give consumer and business sentiment a final jolt. He spoke exclusively with Bloomberg from the sidelines of the Hong Kong Monetary Authority's Global Financial Leaders Investment Summit.
Last year was, I would say, the re-establishment of Hong Kong as a real business destination and hub. This year, I think we're slightly celebratory because Hong Kong's actually doing quite well. Signs of recovery. The Chinese market is Chinese market is beginning to improve. Obviously, seeing significant improvement in equity markets. Sentiment shifting. We're far from done. We know that, but I would say now it's about really getting back to business and getting back to growth in Hong Kong and China.
I think the first panel of the day, and we have a fantastic lineup there. I think you have the CSRC, you have the who's who effectively of Chinese officials there. Do you think they've managed to put a floor underneath both the market, the economy, and sentiment? I mean, those three can be separate things.
I think there's been good progress on all fronts. So I think the monetary stimulus, one obviously was stimulating the economy, but also put a little bit of a floor under the property price disaster. Right? It's been a really bad recession in property prices, and we haven't recovered yet. And there are some nascent signs of recovery, but basically I think they put a floor under it, and it was a clear statement. We're not going to let this thing get out of control. The recent local government debt swap, I think, took another issue off the table, which was the local government finances, which we know that a lot of those governments were financed by land sales, which have gone to something close to zero given the property market. So just stabilizing that takes a big question off the table as well. There's suggestions that there will be further fiscal stimulus to get the economy going, but we all know that confidence is still quite low. Consumer confidence is low. International investor confidence is low. There's also some geopolitical stuff going on there. But local and entrepreneur and business confidence for investment is low as well. So you probably need one further jolt to get that engine.
What do you think that would be?
Most likely fiscal stimulus. There could be a little bit more monetary. There could be a little bit more sort of directed social financing for small businesses, things like that.
Okay.
So I think we'll see those kind of programs. But we all know that China is full of animal spirits, and that the animal spirits were squelched for the past few years, given all the challenges that China has experienced. We got to get those animal spirits going again. I can tell you, I'm beginning to feel that in Hong Kong in a more material way. But China's obviously a much bigger place. It's a tougher ship to turn.
Yeah, I mean, we've been here, I think, the past 3 years as well, and I can tell that the vibe and the energy is different this time around. The guest lineup, the location is slightly bigger as well. One last question on China. You put the banking hat on for me. Do you think it's a good idea to bring all that debt back onto the formal balance sheets, whether that's the banking system or the central government?
Yeah, I do. I think there was a big overhang for two reasons. One, it was unsustainable at a local level. So the alternative was some kind of default or perennial forced restructuring, which is never builds confidence.
Right.
And second, it wasn't very transparent. So we didn't know exactly how much there was and where it was. I think this just takes one big question off the table. Of course, there are lessons to be learned about financing local operations through property sales or property transactions. But this also frees up the local currency, the local government balance sheets for the kind of stimulus program that could come next. Right. A lot of the implementation of any stimulus is going to happen locally. Right. It's not going to come from the central government. Now these balance sheets are freed up to really get the economy going again.
And it's the sense you're getting to that officials have taken into bigger consideration the private sector and what the market and how the market actually feels about what they're doing.
I think the representation we're seeing here at this forum today, and at similar fora that I've been to in China this year, the government is all in terms of re-engaging the private sector in the most fundamental way. It takes time. These sort of confidence rebuilding things. We've been through it in whether it's the U.S. or Europe or Korea or Japan. We've been through these transitions many times, and fortunately for me in my life, many times. In almost every case, it takes longer to get going, and then it happens faster than you thought. Okay. But I think we're in the get-going phase right now.
That was, of course, Standard Chartered CEO Bill Winters talking to Bloomberg in Hong Kong. I want to pivot back to this market move that we're seeing at the moment. You're seeing a number of safe havens catching a bid. You're certainly seeing movement to the Swiss franc this morning. You're certainly, as you can see, seeing movement in the Japanese yen, which is catching a bid. You're looking at dollar yen there on your screen there. As you can see, a fairly violent move. You need to zoom out a little bit just to put it in context. But this seems to be on the back of these headlines that we're getting relating to what is happening in Russia and a decision, it appears, made by the Russian President Vladimir Putin to approve an expanded use of nuclear weapons in Russia's doctrine. This appears to relate back, of course, to the use of longer-range weapons being supplied by Western allies to Ukraine for use in Russian territory. And this takes us to what is happening in Germany. Olaf Scholz, the German Chancellor, defending his decision relating to this issue not to give the Taurus long-range missiles that Germany has to Ukraine, even though the US has made that decision and authorized Kyiv to be able to use its weapons to strike inside Russia. So this kind of all relates back to what we're seeing in terms of the screens that you're watching so carefully at the moment. Bloomberg's Ollie Crook joins us on this story right now. So Olaf Scholz is making the decision that he feels that the risk is too great to make this decision to allow Taurus to be used by the Ukrainians inside Russia. I'm assuming that this is very much relating back to what we're seeing in Germany in the election process that is unfolding. But how much pressure is he under?
Yeah, listen, I think he's reaching a lot of pressure from a number of different allies, particularly from the G7. I mean, the sort of old playbook we've seen throughout this entire war in Ukraine is basically the U.S. is the first one to act, says, you know, we're willing to deliver tanks, for example, and then Germany follows and falls in line, and never really wanting to be the ones that sort of cross lines initially. That has been sort of Scholz's policy throughout this war. So the hope for the Ukrainians, at least, was this move from Biden would potentially allow Scholz to make that decision and to allow those Taurus missiles to come through. That is something that Olaf Scholz has basically shrugged off and says that absolutely not. He is not changing on his position. It is interesting to have Biden make that decision, and now in the context of what we're getting out of Russia from Putin here, who we understand approving the expanded use of nuclear weapons in the doctrine. Just to give a little bit of context to what this is, basically back in September, Vladimir Putin said that Russia will revise its nuclear doctrine to include a response to aggressions by non-nuclear states that is supported by other nuclear powers. It's not hard to read too much between the lines of what that means. Basically the support of Ukraine from, say, the United States and other Western countries, and saying that basically an attack on a Russian member of a coalition will be seen as an attack by that coalition. An attack by a non-nuclear country aided by a nuclear country will be seen as a joint attack. We heard from Dmitry Peskov, the spokesman for the Kremlin, saying that this doctrine was updated in a timely manner and that Ukraine using missiles could cause a response. So that is sort of, you understand a little bit more of why the Scholz position and a real reticence to try to give that sort of carte blanche to the Ukrainians, particularly as he's running this election campaign in Germany, where you have on the one hand the CDU, who have really been in favor of delivering these long-range missiles. And we should say these Taurus missiles can strike much further than the American ones. They can go more than about 500 kilometers. While on the other hand, you have the AfD on the far right and Sarah Wagenknecht on the far left, who have both been sort of advocating a policy of retreating support to Ukraine and really focusing on the question of escalation. And it seems that Scholz is really on the side of not wanting to escalate the conflict, though it must be said he has pledged his sort of continued support to Ukraine for as many years as is required.
Oliver, thank you very much. Thanks for the timely update. Bloomberg's Oliver Crook there, joining some of the dots for us between what we're seeing in the markets and the commentary we've had out of Russia in the last half an hour. And the two do seem to be linked. We are watching that unfolding on our screens right now, even if well flagged back to September, as Oliver was talking about. Let's dive deeper into some of the market moves that we're seeing here, what we're watching in markets. Bloomberg Markets Live. Ven Ram joins us now for analysis. Let's start with the yen then, Ven, because we're seeing some quite substantial moves here in the yen. But it's not alone. It's a sort of classic flight to safety on geopolitical concerns. Is that what we see in front of us?
I think what is going on, Anna, is the idea that, look, we have, the markets are priced in plenty on the fears of trade tariffs and how that's going to be inflationary. And I think that, that trade has run for almost a month now, if not more. And therefore, there is a bit of profit-taking opportunity, and that's what we are seeing. What is adding to the yen's relief is the idea that Kevin Walsh may get the Treasury Secretary post, and he's seen as someone who is hawkish on monetary policy and also less protectionist. And therefore, the idea of the tariff trade may have come to a fruition so far if he's nominated. But these are early days yet, clearly, and we are in speculative territory. But there is scope for the yen to unwind its recent losses, and that's what we are seeing at the moment.
Well, then you're seeing it across the board in terms of that kind of traditional haven bid as well. You're seeing it in the Swissy, for example. And I'm curious how much of that trade is still alive and well when Japan and Switzerland are both dealing with inflation issues of their own. Is that the right hedge, or is this just a knee-jerk reaction?
No, I think that the Swiss franc is a completely different story, Kriti, because if you look at inflation in Switzerland, they are averaging 0.6%. That's as low as it's gotten anywhere in the developed world in this cycle. So I think that what we are seeing for the franc is the idea that, look, the franc is going to do better than probably all the other European currencies should the trade tensions come to a simmer. And if that happens, I think that the franc has a bid on it because, it's a net external creditor to the rest of the world. I mean, some 110% of GDP, to the extent of 110% of GDP, that's huge. And that naturally provides a ballast to the franc in terms of stress, in times of distress. And that's what we are seeing at the moment. And I think that the franc has got plenty more legs in the months to come.
All right, Bloomberg's Ven Ram walking us through some of the major moves we're seeing in the currency market this morning. We thank you so much. We are seeing a red headline across the Bloomberg terminal that China's chip advances are stalling as the United States curbs hit Huawei's AI product. Now, the context is important here because we know that Huawei has been quickly trying to find not only alternative, supply chains in terms of chips, but also trying to find a different market to actually get them. And this is something that, as we've seen the United States quickly phase out Huawei product and Huawei, even the suppliers that get products to Huawei and raw materials, It looks like they're trying to maneuver that.
And you do wonder whether this gets even tighter, even more draconian when we get a Trump administration coming into power in January. That would have to be the assumption.
Yes, and people familiar with this story talking to Bloomberg, suggesting that the US-led restrictions that prevent Huawei's chip-making partners from accessing some of the ASML technology is really the key thing here. And so, yes, how the Trump administration decides to move forward on that particular policy or not will be crucial, no doubt.
And it's an important one as well for ASML because more of their exposure is in China than it is in the United States, despite, and this is a real sticking point with the Dutch government, which really wants to appease both sides. They can't do it. It's a fascinating one where the corporate sector, the tech sector, the immigration policies, the politics, it all kind of comes nicely together in a little bow.
Yeah, meanwhile, still witnessing this sort of risk-off mood in markets. We'll try and unpack that a little bit, no doubt, through the next hour of programming. Some of these lines out of Russia giving investors pause, it would seem. Coming up later today, don't miss our interview with the JP Morgan Investment Banking Chairman, Madhu Namburi. That conversation at 5:30 p.m. UK time. Little risk off then across European markets this morning. We will leave you with the pulse. That is up next. This is Bloomberg.